Welcome to Views from the North, a Canadian rates and macro podcast. This week I'm joined by Jeff Oland, one of our Government of Canada bond traders. This week's episode is titled, I'm Over It. I'm Ben Reitzes, and you're listening to Views from the North. Each episode I will be joined by members of BMO's FIC sales and trading team to bring you perspectives on the Canadian rates market and the macro economy. We strive to keep the show as interactive as possible by responding directly to questions submitted by our listeners and clients. We value your feedback, so please don't hesitate to reach out with any topics you'd like to hear about. I can be found on Bloomberg or via email at benjamin.reitzes@bmo.com. That's benjamin.reitzes@bmo.com. Your input is valued and greatly appreciated. Jeff, welcome back. You always have good thoughts. Thanks for coming on the show.
Thanks for having me. It's great to be here.
Let's start with June 1/2. They're over and done with now. Apparently we're over it. How did that hyped up Canadian bond market event go for yourself?
Well, I would start by saying it is usually a little overhyped, but it's a big event. It's very specific to Canada. And I think it's worth talking about something that just occurred only to highlight maybe some changes in the market structure. In prior years, there wasn't maybe as much participation by what I would kind of term global hedge fund kind of pod shop discretionary investors. And I think as those investors have grown, they're looking for different areas to deploy capital. Canada has become one, and it's made June 1 much more of a two-way trade. And that's what we saw. A lot of buying, but also a lot of selling, a lot of interest to kind of fade the seasonal calendar. And that'll just be something to watch as we go forward, where there's a lot of global money in the Canadian market now that is focused on the sorts of things. Maybe these were things banks used to do 20 years ago before the GFC, where they had the risk capital to be taking the other side of some of these trades. And that's been pushed to the quote unquote shadow banks. But in any case, June 1 and some of these extension dates have become more of a two-way flow than I think they probably were 10 years ago. So from our seat as a dealer, that keeps things fun. It was interesting, but it definitely wasn't a one-way affair. There was lots of participants looking to sell into the strength. And as a result, we didn't really have any big dislocations on the day. And I think that's worth noting because it means in order to kind of generate alpha, investors are going to need to be able to warehouse risk for longer. They're going to need to be able to look ahead in the calendar and try to plan how they're going to come around these events. It's not going to be as straightforward as waiting for 4 o'clock on the day for something that's totally mispriced and then going the other way. And case in point has to be, as we're speaking today on June 3rd, Canada-US has richen about 3 basis points today. So for all those that use the June extension to come out short, they're offside a few basis points in a pretty one-way trade today. And so clearly, if Canada-US was such an obvious sale because of the coupon, it hasn't played out that way. And I think that's because, of the dynamic I just described.
That makes me wonder whether positioning now is short Canada-US, which is interesting, and also in steepeners, just kind of opposite trades. That means almost either way, no matter, like we get jobs in Canada on Friday and the US, no matter the job print, if it's a surprise either way, you're going to get a squeeze. So either the steepeners get squeezed out into flattening, or the short Canada trades get annihilated in Canada riching. I feel like that one will probably be more painful than the other. How do you view that?
I think this year, definitely in March, people were hurt badly being long the front end of global bond markets, not specific to Canada. And in a sense, back to the global kind of pod shop, shadow bank, whatever you like to call it, I think there's a misperception that these investors are weak hands and they always have to get out. There's a subset of them that are, but there's another subset that are taking a lot of risk and have the capacity to hold that risk. And in March, it was a major VAR shock, and definitely people were long Canada, and that was painful. But I think people have largely held on to those positions. It was kind of a quick shock. And so in the total scheme of things, the new shorts being initiated here in the long end are relatively new. Like, I don't think people were really aggressively selling Canada-US longs at minus 100. Maybe at minus 120 people have started. But for sure, people have been buying Cat 2s north of 3%. It would be difficult for us to find any investors we speak to that were selling them there, even hedgers. And so I think in terms of positioning and how we should expect the market to trade into this number, my sense is people are definitely in steepeners again and along the front end. And I think it's common to just say, okay, well, let me size up which way the market is and contrarian go the other way. I don't know if that's the right take necessarily. Sometimes the consensus is right. Sometimes you get these opportunities and you get paid for having the wherewithal to hold them through a major VAR shock. But yeah, I mean, positioning, I think short Canada US is only starting to build. And so I think in the long end, like 10s and bonds, that might only be a 3 out of 10, not a 10 out of 10 by any means.
Okay. Just worries me that if we get a bad jobs number on Friday, that all those guys that just initiated might get squeezed out. That's a concern for me.
Well, yeah, and it's a valid one. Although I think the threshold to have that happen is quite a bit bigger move. So I actually myself, and maybe we can get a bit into this, feel a little more like there's reasons to be optimistic on Canada and reasons to think Canada-US might actually be able to cheapen. But yeah, in the near term, I would say I would just go with positioning right now. I would say it's probably
that's what I'm afraid of positioning. So I actually agree. I think you want to look for opportunities to fade that Canada strength, but I don't know if it's here, which is my issue, and not like where we are because of positioning. We're vulnerable to a weaker number, as opposed to really getting crushed by a stronger number. Let's say, which I guess we might, but the positioning's not there at all. Like you just get people adding, I guess, or more people jumping on board, which is fine. And the algos are probably going with that as well. I mean, it's pretty clear that like you have the surprise index being super negative for Canada and especially super negative relative to the US. So things are seemingly terrible in Canada. And that's always the time that you always fade that nearly all the time. Maybe this time's somewhat different, dare I say. Just because like you have this trade uncertainty and like the Canada-US relationship and correlation isn't quite what it was. So even though the US is like seemingly going pretty well, like all the US numbers are pretty good. Maybe that doesn't spill over into Canada. I don't know. But over the past, call it 15 months or so, anytime the Canadian numbers have gotten really bad, it's been a pretty good fade.
Yeah.
And you would have been better off betting against that and then things slip. Now, whether that starts with jobs or not, I mean, jobs are impossible to predict. I was going to say notoriously difficult, but I'm just going to go with impossible. And it's either like consensus is like plus 10 all the time because nobody really wants to be negative and nobody wants to be overly positive. And so it's just kind of like pick one and it's like, okay, I'll just go with plus 10. But like it's hard, I think, to pick that out, and it can go either way on Friday.
But I would say the people who have built up these positions in the front end, they have reason to. I mean, the numbers have given them every reason to want to be long. And I guess one of the things I wanted to ask you, just can we talk a little bit about the economy? And I'd also like to talk a little bit about how the Prime Minister, how you score the Prime Minister first year into the job. For myself, I think everybody's happy that sentiment from a business perspective has changed, but maybe is it fair to say we haven't had enough actual tangible changes in legislation and policy to improve the growth situation? Or is it that that's coming around the corner and the market's going to see through the short-term weakness in the economy and look forward to kind of more business-friendly government? So could you talk a bit about that, and then also talk just what do you see for risks? Obviously, we have the USMCA.
That's it.
Yeah.
Honestly, that's it.
Yeah.
There is only one real issue for Canada. So on the government, it would be encouraged but underwhelmed. Is that reasonable?
Yeah.
So like right talks in the right direction. The tone's the right way. Like, yeah, let's go. We want to do business. You want to do business. Everybody wants to do business. Let's do some business, but we haven't done any business yet. It's like, well, hold on a second, but you want to do business, but we haven't done it yet. So the thing is, it is hard for government to do anything. And historically, somewhat notoriously, like any fiscal stimulus always comes after the fact. So you get a big crisis, fiscal comes in. It's like, a year later, the fiscal kicks in. It's like, well, the crisis is over. Like, what are you doing? And so I'm not sure this is that different from any other time. It takes some time to push things forward, but the tone has definitely changed. Like, so I'm looking forward to Prime Minister Carney's investment summit in September, when he's going to bring together global investors, including but not limited to like Canada's major pension plans and other global investors, and pitch the Canada story effectively and the major projects that they want to put in place. And I think going into that, it's in September. I think going into that, like they've announced this, I think they announced it like 2 months ago. So you're looking at like, it's June. So what, May, April, 6 months in advance, almost 5 months in advance, they announced this thing. Maybe it was 6, but if you're announcing it that far in advance, like you better know that something good's coming in the meantime. So I'm guessing that there's some positive project announcement that's going to come either right before or maybe right after this summit, this investment summit, to really just reinforce the fact that like capital is welcome to Canada. Like, hi, I like money. I like capital. Please come. Versus like, nope, get out of here. We don't want you, which was the way it was for a great number of years. And so I'm hopeful for a positive result there, an announcement. And that would just reinforce that positive sentiment that we're seeing and put a little bit of substance around it, which would be important. So tone is important. And I wouldn't understate how impactful that could be. And the one thing I'd say concretely, and it's not from the government, but from the private sector that's encouraging, is that the Shell purchase of Arc Energy or Arc Resources was encouraging. Like that was the first inward investment we saw for, I think it's 11 years. Like it's been one way for 11. That's a long time. You've had a decade of money going out, not in. And so if money finally came in, and it's one company, I get that. That's fine. But there was also like a U.S. shale company or energy company that was looking at Duvernay and buying some property there. And so like the tide seems to be shifting and things are turning a little bit. And so like it is encouraging from that perspective that there are at least some early signs. It's not definitive.
I think I think that's fair. I feel the same. And I think it's tough. Because if all of us were to step back and say, okay, what's quote unquote wrong with the Canadian economy? I mean,
I have a list right here.
You would have a list. But one of the aspects might be nothing per se. It's a somewhat more cyclical economy because it is so resource focused. And of course, we'd like to get a little diversification from the resource focus, especially when we look at how things have been in the U.S. with having a bit more of a high-tech sector than we have. But that said, the resources do cycle, and if we're in an upcycle here for commodities and with the right government, I mean, it might be an excellent time to be an investor in Canada. And I think that's probably part of the reason to be optimistic for things. You get the right kind of macro environment and also the right government, things could really take off here. So I think for me, that's definitely the bull case. I don't know, that's not going to matter on Friday, probably won't matter for 6 months. But as I say, we're a year in now to the new government. Maybe, these are the sort of things we'll start to see clicking that really will make a big difference. One question though, before we move on from that point, I wanted to ask about GDP, the government sector in the most recent print was a big net detractor, and that is part of the platform, I think, to slim down the government a little bit. I mean, am I over reading into this? What's your take?
Yes and no. So they are doing their best from a government spending on operations perspective to rationalize things at the federal level. And the provinces also are cognizant of the fact that like deficits are not small, spending is not low. And so we need to be a little bit more wary of really ramping things up on the spending on government operations side. And that was negative. But what was also negative was the government like infrastructure investment side of things. So government investment was down, and that's more a function, I think, entirely of it was up massively in the prior few quarters. And so like a bit of retracement on that, you can get some chunky moves. If we buy, I don't know, a bad example would be like fighter jets. And I only think that because that's the only thing anyone talks about. But you buy a few expensive things in one quarter and not in the next quarter. And so it can move the needle a lot up or down. And so that can do things. I don't know if that was in Q1. I haven't looked into it. I don't think it matters, quite frankly. I would say that's more of a temporary factor than anything else. You are going to continue to see government infrastructure spending. That's like, there's no question. Every province in the country needs more infrastructure. We let in a zillion people, seemingly. It wasn't, but it felt like it. And government services at every level were degraded accordingly. And so it's time to build up that capacity. And that's what we're doing. And that will continue. That's not going to change. That's in every budget. Every single provincial budget has lots of infrastructure spending. And the feds do also. And so that's going to keep going. And so you're going to have continued growth there. That doesn't change. And Q1, I think, is probably more the exception than the rule. And I would guess that you are going to see government spending rebound, maybe not massively, but rebound in the next quarter. And instead of subtracting nearly a percentage point, it goes, not quite, but goes the other way and adds a few tenths here or there. The consumer hopefully hangs in there. I think that's probably the bigger risk and the bigger worry for me, rather than government. And then the economy hangs in and hopefully comes up with a positive number.
How's the Bank of Canada seeing things?
Depends what happens on Friday. I'll be honest with you. Like that. I mean, it does and it doesn't. That's kind of unfair. Like either way, they're not doing anything. Like rates are not moving next week. There's no chance of that. But their tone can change significantly. And so like in April, it was, be warned, we will hike in consecutive meetings if CPI is too strong. And that freaked a lot of people out. And I get it. That's fine. That's fair. That was a risk. If oil were to continue going higher or stay really high, then sure. Since then, oil has backed off notably. And inflation came in softer again. That's 7 months in a row of pretty soft underlying inflation. And we'll see what jobs do. Like if jobs are weak, the last jobs print was pretty bad. We've had negative job growth in 3 of the first 4 months of the year. You can get another bad number and the unemployment rate goes to 7% or higher. Like, I mean, geez, that's not a great sign for the economy. And you're going to hike rates into a widening output gap. That doesn't seem like great policy especially when the underlying inflation is pretty weak. Like I almost think like my everything I come back to, and every time I think about it, like CPI is the best signal for me. Like it's super lagging. There's no doubt about that. But like it is the one that is probably the strongest signal that when you get still relatively soft core inflation numbers, when oil prices are surging higher and there's no pass through at all and no sign of pass through anywhere, like that should be pretty telling that like maybe they can't pass prices along because people can't afford to pay those prices. And I go to the grocery store and I see a few more sales here and there for stuff that I like to buy. Like me and my children love bubbly or Pellegrino or anything that sparkles, quite frankly, that's not pop. And it's been on sale. I think every time I've been there for the past month and a half, 2 months, I'm pretty sure one of them has been on sale. And maybe that's very specific, which it totally is. And it could be totally full of it and completely irrelevant. But I just think it's indicative of the fact that like people can't necessarily afford all the stuff that they might want to. And passing along price increases just may not be as easy as it was, say, in 2022, 2023, 2021, when money was ample and liquidity was everywhere and the government was giving money away and rates were zero. Well, 2021 at least. And so the bank, I mean, no rate change. I think the base case is still no rate change the rest of the year. That I don't see that changing anytime soon, but they probably either way soften their hawkishness at least a little bit, just based on oil prices coming back down below $100. And then if the job number is bad, they soften it extra, and maybe I would just change the whole conversation away from this consecutive hike thing and not mention it at all and just pretend like it never happened. Easy way to do things. And if it's a good jobs number, well, then like, great, the economy's actually hanging in there, but still there's no real rush to be pushing rates higher at any point in time. And so like either way, soften that seemingly hawkish bias that we got in the April meeting.
Yeah. I like the good quote, it's not the critic who counts. And I think it's easy to be critical of the bank. I find they do something which I like. It's a little more old school, and I think the new governor, Warsh, is going to move away from forward guidance And the bank has a good way of kind of saying both sides of the story without giving away what they're going to do. I mean, in last year, they definitely at the margin were retaining a dovish bias, but it wasn't so explicit. And I think that's what my expectations would be for it, is that they're going to keep their options open. And the market seems to be kind of getting ahead of the bank is going to be a little more on the dovish side, the Fed may be a little more on the hawkish side. So maybe that's setting up for a trade, but I think we're in the middle of that getting kind of put into the price. Yep. And so housing for me in Canada remains a concern, more so in Toronto and Vancouver. The last time I was on here and I mentioned this, someone took that and messaged me about housing in their city, which wasn't Toronto or Vancouver, and how on fire that's been. I think
so. We have at least one listener.
Yeah. I don't think it was my mom, but it might have been. And so that part, I just think as long as rates stay here or they threaten to go higher, it's tough to see housing turn. If housing did turn, though, then I'm going to go and put myself in we're going to get 2 hikes or so this year. But it's contingent on housing, and I don't see that happening yet. So I think we'll have to see that. I'll have to see how the data evolves, of course, but there's no catalyst. And I think that one of the things that has kind of frustrated people in general is we've been looking for the next big move one way or the other. And if I even just think about like the yield curve and the business cycle, we disinverted the yield curve almost 18 months ago, almost 2 years ago. And typically that's a good tell for a recession. When you disinvert the yield curve 6 to 18 months later, you have a recession. Well, this time around, we didn't have that. So setting where we are in the business cycle is really difficult. If you believe we've kind of reset the cycle, then we need to reinvert the curve and then disinvert it again to follow the old, just as one indicator. So in that case, like this business cycle could have a long time to run still, which to me says the next move, and this is something maybe I'd have a little more conviction on betting, the next move is a hike. It may not be this year, but I don't have a problem saying they're going to hike 25 basis points at the end of this year. I just don't think it's that crazy. But the housing is the contingent factor, and we'll just have to keep an eye on it.
So I don't mind the hike by the end of the year. I wouldn't put high odds on it, but it's not possible anyways. Housing, there's no way it rebounds. Like I don't know what would do that. Nothing says it will rebound. So you have population growth of 0 or maybe negative. Rates are not low. In fact, they're relatively high on the mortgage side because of the rebound in rates across the curve. And valuations and affordability is still not good in Toronto, and it's not good in Vancouver. And let's talk about the rest of the country. Well, the rest of the country does not have the population growth that they had. And so that one was fueling a lot of that growth. And so you're starting to see the rest of the country, rollover is probably the wrong word, but like the strength in those parts of the country, it's not going to be what it was a few years ago. And so you're seeing kind of those areas top out. I would say to some extent, Ontario, BC still like bottoming. It's more, BC seems to have bottomed a little bit earlier than Ontario, but things aren't getting worse in either one. But neither one can really afford a hike, and housing will not be a reason that they hike at all. I don't think that would shock me.
I think just to reiterate the point, it's not that it would be a reason for them to hike. It would be good enough to not prevent them from hiking. I don't expect like a major. I mean, it would be very difficult to see a major rebound in a hiking environment generally, and from this level, it would be very hard to see. But I'm just saying, if we could picture a situation where inflation is 3%. We're starting to kind of greenlight resource projects. Hiring is on the move. Is it so crazy to say, they're going to move the overnight rate to 3% or something?
No, that's not crazy, but it's going to take a trade deal. Everything, it's still, even housing comes back to that. Because when you get the trade deal, activity picks up, hiring picks up, you have a limited population growth, which then means you got a tightening labor market, wages maybe take a bit of time, but push higher. Things get a positive cycle evolving from that, and then things can start to go. But I don't know what other positive catalyst there is, at least this year, to move things that quickly outside of a trade agreement. I think over time you can get the government and their major projects to do that. That is over time, sure, but it's not a 2026 it may not even be a 2027 thing. It might be like a 3-4 year project. But short term, if you were to get a trade deal, I still think, and we might even get it. I don't know. Probably not in the next month or so, but you still might get that trade deal, and that will be, I still think it's coming, a game changer for Canada and for the outlook and for rates, and that will change things for Canada. And then it's probably a relatively quick trip back to neutral. I don't think it's like you get a trade deal and 2 months later they're hiking rates. No, but within 12 months you're probably back at neutral.
Yeah,
that's kind of the way I see it, assuming things haven't really worsened materially in the near term.
And just back to the PM, if he can do that, he's got quite a bit of momentum behind him. So a lot could happen from that. Okay, what about trades? Just finish off trades you like, trades you don't like.
Geez, what are you, the host or me? I'm confused. I'm. We were saying going into June 1 that you'd probably want, historically, you'd want to sell Canada, and the fact that everyone piled into that trade before we could even think about it effectively, and Canada didn't reach in at all in June 1 really concerns me personally. And like, we didn't do it because of that, and you didn't get an outsized move, Richard. So there's nothing to fade. If you get a bad jobs number and Canada does rich in a whole lot, I think you can start putting that trade on.
Yeah.
I think like you probably start to get a bit of a squeeze on those guys, and maybe they have more leash than I think they do, but nobody likes losing. They're already a couple basis points offside today. 2, 4, 6, 8. Like, at what point do you cut those positions? I'm not sure, but I would be a lot more comfortable if like 10s got closer to, or like 105-ish now. Let's call it 115-ish or so, maybe 120. Like, at that point, man, I don't think you want to be long Canada. I think you definitely want to be short. Curve is harder, I think. I think like bigger picture, you probably want to be in flatteners, because as you said, like the next move is probably a hike, I think, but you still might get a little bit more weakness in the near term. The surprise index tells us that like Canada probably doesn't weaken a lot more, and it's just a matter of time before you get the turn. But do you want to try and catch the falling knife? I'm not sure. The front end is pretty reasonable here. Like, you're just over one hike priced at this point. Like, this is where I wouldn't say fade it yet. If you get sub one hike, we'll see what the jobs numbers do on Friday. But given the current information we have, if you had a little bit less than one hike, I'd probably fade that. But we're not quite there yet. We're still just short of that. So not much to do there at this point.
Yeah, it's trading like the number's going to suck Friday, and so yeah, if you get a bad number and you get some better entry levels, I don't think you buy twos on a bad number. I think you sell twos on a bad number. Yes. And on a good number, I think you sell them too. So it for me, the last third of a move is the tough one. It's kind of had its move for me, like in terms of risk reward. But I'm not sure you want to go into that number short or in a massive flattener. But I think if you feel as I do, you're probably looking for entry points, and the risk to that is the housing market, which you mentioned, and for that, I think you just keep an eye on credit spreads. Like, as long as credit's tight, and it is pretty tight right now, I just think we're not going to have a recession that everyone's been calling for years. And so as long as that's the case, then I think you're okay to be in these trades, which say essentially that we're earlier in the business cycle than people think. And, you have to go back to the old playbook. What does the beginning of the business cycle look like? Which I know, first of all, it's confusing. It's a difficult environment because of some of the things I mentioned. And so, you always have to be kind of reassessing where are we? But in my mind, we're not really, really late cycle. We're actually kind of early cycle. And so if you think that way, then those are the trades. So that's how we're approaching it. But of course, we're always looking for areas where we might be wrong.
Jeff, you trade 10-year generally, like broadly, whatever. If I look at a chart of 10-year yields, look at a 6-month chart, they've largely traded in a 340 to 350 range. We are in that range at the moment. You had a February huge rally, and that's the outlier and kind of the inflation period post-war, but it's been mostly in that range. We're at the bottom of that range now, or toward it. I mean, you've had so much bad data in Canada, and there's pretty meaningful amount of negativity around Canada, and you're still only just at the bottom of the range. It's just really hard for me to be bullish on rates. If you got a global move, sure, that's fine. Like, I get it. But I mean, otherwise it's hard for me to be like, yeah, buy 10s here. This is a great level. It's like, no, we're at the bottom of the range, and things, Canada might or may not be falling apart, and we're only at the bottom of the range. Well, yeah, I'm a little bit worried.
It's one of the things I love about the market making seat is, one, we're given the liberty. In fact, we're required to change our mind quickly, and so I like having that mental flexibility. And two, we can look at a chart like the 10-year, which has been pretty noisy, pretty random, and say, if I were a real money investor, I don't know how I would have really fared in that kind of market, but we're able to do okay just, trading that around. And so, it continues to be one of those kind of markets where, flexibility is probably valued over having high conviction one way or the other. But that's how we're definitely seeing the world.
All right. Sounds challenging.
It's been fun.
Fun is definitely a word. Jeff, thanks for coming on. I very much appreciate it.
Thanks, Ben. It was great.
Thanks for listening to Views from the North, a Canadian rates and macro podcast. I hope you'll join me again for another episode.
The views expressed here are those of the participants and not those of BMO Capital Markets, its affiliates, or subsidiaries. For full legal disclosure, visit bmocm.com/macrohorizons/legal.